Every purchase for the business goes on a personal credit card. Every business expense gets tracked mentally, separated only in a spreadsheet, while the actual credit obligation sits entirely on personal credit, personal liability, personal risk. This is how almost every small business and side hustle starts, and it's also exactly the setup that quietly caps how much capital access is ever available, while putting personal assets at unnecessary risk in the process. Tonight, the fundamentals of separating personal and business credit, why an EIN alone doesn't actually accomplish what people think it does, and the real sequence for building credit that belongs to the business, not to a personal name. Getting an employer identification number, commonly called an EIN, feels like the moment a business becomes financially separate from its owner. This is only partially true, and the gap between what people assume and what actually happens is where a lot of confusion starts. An EIN is essentially a social security number for a business, used for tax filing and, eventually, for building a business credit profile. But simply obtaining an EIN doesn't automatically create business credit, doesn't automatically separate liability, and doesn't automatically stop personal credit from being involved in business financing. Genuine separation requires deliberate structural steps beyond just having the number. Skipping those steps while assuming the EIN alone provides protection is one of the most common gaps between what business owners believe and what's actually true about their financial exposure. Real separation requires several specific pieces working together, not any single action alone. A proper legal business structure matters first. Operating as a sole proprietorship generally provides no legal separation between personal and business liability at all, regardless of having an EIN. An LLC or corporation creates genuine legal separation, meaning business debts and business credit are generally tied to the business entity rather than the owner personally, assuming the structure is properly maintained. A separate business bank account is essential, and this matters more than people initially realize. Mixing personal and business funds in the same account, sometimes called commingling, can undermine the legal protection a proper business structure is supposed to provide, and it also means there's no clean financial trail demonstrating the business as an independent financial entity when applying for business credit. A dedicated business address and phone number, distinct from purely personal contact information, is generally required by business credit reporting agencies to establish a legitimate business profile. Business credit accounts that report specifically to business credit bureaus, separate from the personal credit bureaus most people are familiar with. This is the piece that actually builds a business credit history, and it requires accounts specifically structured and reported this way, not simply using an existing personal card for business purchases. Building business credit follows a real sequence, similar in spirit to building personal credit, but through an entirely separate reporting system. Establishing trade lines with vendors who report to business credit bureaus is often the starting point. Many suppliers offer net 30 payment terms, meaning payment is due 30 days after invoice, and consistently paying these on time or early begins building a positive business payment history, assuming the vendor actually reports that activity to a business bureau. Business credit cards specifically issued to the business entity, using the EIN and business information rather than relying purely on a personal guarantee, are the next layer. It's worth understanding that many business credit cards, particularly for newer businesses, still require a personal guarantee from the owner initially, meaning personal liability isn't fully eliminated even with a business card until the business has enough independent credit history to qualify for accounts that don't require this. Consistent, on-time payment across these business-specific accounts builds the actual business credit score over time, tracked separately from personal credit through business-specific scoring models rather than the consumer credit scores most people are familiar with. Beyond simple organization, real separation between personal and business credit has concrete practical benefits worth understanding clearly. Personal liability protection, when properly maintained alongside a legitimate business structure, means business debts and business credit problems generally don't directly damage personal credit or put personal assets directly at risk, assuming the structure hasn't been undermined through commingling or improperly maintained formalities. Higher capital access becomes available over time. Business credit limits, once a business has built genuine standing, are often substantially higher than what personal credit alone would support, since business lending decisions factor in business revenue and business credit history, rather than being capped by personal income and personal credit limits alone. Personal credit utilization stays protected. Every business expense currently going on a personal card is contributing to personal utilization, potentially damaging personal credit scores through business activity that has nothing to do with personal financial behavior. Separating this protects personal credit from being affected by business cash flow timing. For anyone currently running personal and business expenses together, here's the realistic sequence to begin separating them properly. Confirm the business is structured as an LLC or corporation, not simply operating as an unstructured sole proprietorship, if genuine liability separation and business credit building are the goals. Open a dedicated business bank account and move all business income and expenses through it exclusively, stopping the commingling that undermines both legal protection and financial clarity going forward. Apply for an EIN if one doesn't already exist, and use it consistently across business accounts, business credit applications, and business tax filings. Establish 2 or 3 vendor trade lines that specifically report to business credit bureaus and maintain consistent on-time payment. Apply for a business credit card, understanding an initial personal guarantee is likely required for a newer business, and use it exclusively for business expenses going forward, moving away from personal cards for business purchases entirely. This won't create full separation overnight. Business credit takes time to build, similar to personal credit, but every account established and every on-time payment made moves financial risk and financial capacity away from a personal name and onto the business entity where it belongs. An EIN is a starting point, not a finish line. Real separation between personal and business credit requires a proper legal structure, a dedicated business bank account, business-specific credit accounts that actually report to business bureaus, and consistent management that doesn't blur personal and business finances back together. Done correctly, this protects personal credit and personal assets from business risk, while eventually unlocking access to capital that personal credit alone was never designed to support. This is Credit Clarity. We'll see you in the next one.